2022, it was a tough year for retirement savers. The average balances for 401k and IRA accounts, they sank by more than 20%, according to Fidelity Investment Analysis. And 2023's turmoil has not helped. Here to talk retirement tax strategy is Tim Speiss, who is the partner in charge, much different title there, Tim, partner in charge over at EisnerAmper's Personal Wealth Advisors Group. He joins us as part of our Taxes Made Simple segment brought to you by Fidelity Investments. Okay, so first thing that people need to know as we are squarely in the throes of this tax season and people are getting ready, how can they best position, especially their retirement accounts, as they're planning for that next leg of life, perhaps?
Right. So what they should be doing is visiting with their investment advisor or the plan administrator. They often offer resources, looking at their spending, looking at their goals, looking to a retirement age. We're in a world now where retirement age, it varies. Mm-hmm. People wanting to perhaps take an early out or wanting to work longer. And all of that deserves a lot of thought, asset allocation, spending, a lot of related factors, risk tolerance is everything that should be considered. Also, what do you have now is invested? What are your cash flow needs? We do a lot of that in the context of modeling and helping clients understand. Visually, when they see that, it's very it's very much more real because it's very difficult to think through these things in your head without any modeling.
And it's not just asset allocation, it's a vehicle allocation, if you will. When you're thinking about your taxes, for example, in retirement, are you looking at a Roth? Are you looking at a 401k?
Correct.
What are the different considerations tax-wise?
Well, the accumulation within a Roth is not as powerful. And I would say the tax benefit's not as similarly robust as the 401k plans. I mean, the 401k plans can allow you to defer more monies. And I think that's a significant issue versus perhaps being in a plan that doesn't allow you to do that. The key, though, is participation. Enrolling, understanding your risk tolerance, how you should be investing, taking proper measured risk in the context of maybe some higher yield fixed income. By the way, all of these things would have to be vetted and make sure that it's an appropriate investment for the individual. But most plans that we see have a lot of investment options. But to me, it still comes down to the counseling of the individual. And many firms offer that. Right. They offer the counseling, as does employers. So I would say those are the top three things.
Thankfully, because it's very complicated.
Right.
It is. Well, it is. And sometimes people are just, I can't say it any more gently, it's intimidating. Yeah. Mm-hmm. And they understand that they're investing for 10, 20 longer periods of time. They have families. They're concerned about a healthcare issue that might arise.
Sure.
This is why retirement planning, the way we see it, is done in the context of a total financial plan.
Right. And within that total financial plan, even between last year and this year, how has the number for some of the clients that you work with, how is the number that they keep as kind of the pie in the sky figure, how has that changed between last year and this year, even knowing how their expenses have changed in that interim period of time as well?
Do you mean in the context of, say, a present or prospective like target balance?
Sure.
Okay, yes. I think people have, there's two types here, and I won't say they're extreme, but there are two types. Those that still feel cautious, want to save as much as they can, willing to take some risk, but perhaps not as much as they might have if their state of mind was 4 years back. Mm-hmm. And then there's others that are very sober about where we are. They have a good handle on their finances, their spending, their asset allocation models, yield and growth. So I would say those are the two general types of investors. Others are running funds, and that's a totally different, I would call that a totally different category. But I think what we try to do is understand, very important, the objectives and the risk tolerance. That's really important because you don't want to have your relationships uncomfortable with your advice unless you can help them understand why, and then that they have another choice. And so that's actually the way we approach our total business, actually, across the firm. So it's always made sense to me
Tim,
to approach it that way.
Thank you so much for being here, because obviously this is important stuff for people to be considering at tax season, but really all the time when we're talking about retirement. It's really, really important, and people don't know enough about it and don't do enough about it. So Tim Speiss, thank you for being here. EisnerAmper.
Thank you for having me very much.
Appreciate it.